Hello, everyone, and it's fantastic to have you out, guys, out here for the presentation on Burger King. Burger King. So we all know that Burger King is the latest entrance in the QSR market, isn't it? And the QSR market represents a very, very big opportunity, especially given the fact that the online ordering services that are available like Swiggy, Zomato, DoorDash, and what have you. And what has this resulted in is that we have learned to eat out more, right? Uh, People just order. There is uh, there is total lack on the side of consumers to think about the price that they're paying, right? So we become a society which is a very consumption-led society. We are not afraid to scratch our debit card or a credit card. And from a business point of view, that is a very good sign, right? And you have Burger King, which is one of the largest, second largest chain in the US, coming into India with very, very ambitious plans. And when you look at the optical numbers, you will find that they're loss making and they're not making much money. And where would they be going? But Westlife, which is one of the master franchisees of the McDonald's, has also gone through all these growing pains. Domino's has gone through these growing pains because you have to Indianize and adapt to the Indian thing. Burger King has a head start on that because they've come in late. They've learnt in from the lessons of the other people, and right from day one, their entire menu is completely Indianized, right? And globally, they are known. McDonald's is known as a value for money brand. Burger King is more of a premium brand, but in India, they have chosen a strategy of being completely value oriented. We will see how they are, right? And they are growing very, very fast. Today, in 5 years, when they started out, they did not have a significant uh, ability to start. And then what has happened is that they have gone and uh, really, really ramped up. So when they came here, when they went to set up their supply chain, people were asking them, from where will you get the money? Can you pay as a premium? Because, we are already set up. So they didn't want to load the cost and put themselves in stress unnecessarily. So what did they do? They went about setting up their own distribution chain. And this has helped them to enable them to be cost competitive. They've used technology phenomenally across all aspects, and they are connected to all the global uh, network of Burger King, so they know everything that is happening, which products are being sold, which products are not being sold, what is the trend. So on a real time basis, they are connected to their global compatriots. Okay, in India, Burger King is offered through the master franchise route, and Burger King also has a stake in this company. And today, the IPO which is coming is part IPO as well as a part FPO, which is stake sale by the existing promoters. Okay, so given this background and understanding where we are headed, we are going to take up the equity research and analysis part of the study. And when I choose companies, for me, the single most important characteristic that I look for is in who is running the business. Okay, first comes who's running the business. What about the leadership and the management team, their vision, their strategy? Okay, next comes which is that segment that they are getting into. So what is the matrix, what is the scale, how can they scale up, what is the growth rate, what are the adjacent segments, what kind of competitive threat they have, what is the moat that we have. Competitive advantage is a very important factor. And then we did go into uh, and then we go into the numbers as such. Okay, numbers are extremely important, I agree with you, but getting the story right is far more important, because the story will drive the numbers, and your confidence and conviction in what the management is, whether it's doing right or wrong, will decide what is the assumptions that you make when you build out the model. Okay, and as you build out the model, you will find that things really start moving. Okay, so without much ado, let's get on with the uh, presentation. So let's see what is the market size and opportunity that you have. So in India, the F&B industry is worth 4 lakh crores, 4.1 lakh crores. That's a huge industry. Okay, it's nearly uh, it would be 2% of the GDP, right? Because our economy is 2 lakh rupees, $2 trillion. Okay. Second is, we have, as I spoke to you earlier about the changing consumer patterns that have seen an increase in eating out, has led to a CAGR of 9% growth over 14 to 19. Okay. QSR, or the quick service restaurant business, which it operates in, has a 7.5% of the overall F&B market. So it's tiny, but it's going to grow. And we are while the food market is dining out market is going at 9%, we are going to have the F&B industry growing at about 11% over FY19 to 24. Now, just a small interjection. When I present all this data to my students in my courses, they all ask me, from where do you get these numbers? So, our job is not to reinvent the wheel. All this data is available across very respected sources. You have to take those sources, and they are more of a guiding principle for you. They are not the exact, nobody really knows what is the exact thing, right? These are all projections based on sample studies. Somewhere you have complete data available, somewhere you don't, right? So from various sources, data has been taken and published, and then we are looking to see how we can grow this pie, whether it can grow as it is expected. So, you should not sweat your efforts and frustrate yourself by whether this number is right or wrong. Get the trajectory right, get the direction right, and be convinced that there is ample growth opportunity with good pace of growth compared to the rest of the market, right? So this is what we have. Then, as I told you, the quick service restaurant, 7.5% is 307 billion or 30,000 crores market, growing at 11%. Now, what is a significant nature of this market is that it is a highly fragmented market. Okay, so there are not many players available there. And as we have seen, that the strong get stronger, and the organized and the more efficient players will kind of keep gaining market share. So, even if the market grows, uh, so Mohit, a lot of this data is taken from the red herring prospectus, newspaper clippings, and any kind of, data point available with the big four. You can go to that and check it out. Okay. So, so this is as far as the concept is concerned and the segment. Okay, so the promoter of this company, or the CEO who has come in, is Rajiv Varman. Okay, he's got 20 years of experience in the F&B industry. He's been a big time with Burger King, and he has been with them as country head in various geographies. Okay, Eastern Europe, Asia, etc. And so he knows what the Burger King business is all about. He understands QSR. He knows how to build it up because he has been the originator in many countries and geographies, right? And the promoter, which is the parent, QSR Asia, okay, has 18,675 restaurants across 100 companies. So you're dealing with a very, very efficient player. They know their job, they know their business, and they know what it is to grow in different markets, right? So you're coming from a very, very strong franchise. Then secondly is that, they had today 261 restaurants strong, and they have a plan to roll out 700 restaurants over the next 6 years, right? We are already ending 20. there's going to be another 6 years, and they're going to put up 50 in the coming year, 70 in the following year, and then 80 outlets per annum. So they have a very strong presence in North India. They're about 47%. Next is West India, which is 37%. And they are present in South, but the big growth for them is going to be now East, Calcutta, and South. So, we are a very well established player. They put up 6 clusters and they're using the cluster approach of growth. And what they do is that the first restaurant that they put up, okay, is always a big bang launch, so that you build a word of mouth around you, and it serves as a branding and a kind of a marketing campaign. Okay, so this is some of their store and cluster strategies that they use. Now, what are we expecting is that, so we've been a little bit skeptical about their restaurant opening, because number one, we do not know how the COVID, uh, the re-emergence of COVID will impact the overall market. Number one. Number two is the fact that, you might have aggressive plans, but something or the other can play rookie with you. So we've been a little bit conservative in our numbers, and if they do achieve the numbers that they talk about, then they will definitely surpass this 1361 crore number that they have promised us. Okay. And this 1361 is a conservative revenue CAGR growth of 17%. That is huge. Okay. So we are looking at a 13% CAGR growth in restaurants. Okay. Second, we are going to see better optimal utilization of capacity with improving footfall. So, your same store sales growth will also grow, right? And your revenues will have 3 drivers. Okay. Number one is the number of restaurants. Two is the increasing footfall, and strong same store sales growth, which is a combination of volume and value pricing. Okay. Typically, their uh, pricing will always mirror the inflation that is there in the country. So, same store sales growth could continue to happen to be at the nominal GDP growth, but we have taken not nominal, we are going with the real GDP growth. So, there also we are slightly conservative. Two things which are very important is that their royalties, which are around 4+% right now, will not exceed 5%. So that is there in writing with the master franchisee agreement with the Burger King International. Okay. And currently the ad spend, which is at around 9%, is going to rapidly come off to 5%, thanks to more digitization, more ordering from home. And second thing is the fact that, now that they have got a listing in India, okay, being listed, they will become a household name. Okay, so to a certain extent, people will keep asking Burger King ka bhav kya hai, Burger King बढ़ गया, Burger King घट गया, right? So this kind of newspaper and TV publicity that you get indirectly strengthens the brand in the mind of the people. So now people will think more, rather than McDonald's, why don't we go towards Burger King, right? So this is what they're looking at. Okay. Second is the listing, as I told you, will give them brand awareness. And today they have a lot of debt on their books. Okay. They've grown very fast. They put up 261 stores. But most important thing is that they are the fastest among the 5-6 chains which are there in India to roll out 200 stores. Okay. And all of these stores are owned by them. So they do not have a sub franchisee. Okay. So although they are a master franchisee, barring for the airports, okay, where typically somebody takes out the entire retail space, and you have to then make him a franchisee. Okay. So there are about 8 properties which are, or 8 locations which are the airports which are sub franchise, but the rest of everything is owned by them. So there is a lot of capex that goes into it. Okay, you have to set up your supply chain, your vendor network, you have to go in, and when your stores are not even breaking in, you are still going and opening your stores. So there is a lot of money that is required as an investment phase, right? So you need capital to support your business. So the IPO that they are doing, which is about 810 crores, 162.24 crores is going to go to completely pay out the debt. Okay. Second thing which is very important is, as far as the working capital is concerned, is that they are a net negative working capital company. Okay. So that is really, really great. Okay. So when they have uh, that, this is extremely good aspect that we have to look at. Okay. And what are the things that are going to play out? So, in a business like, when you look at a business like McDonald's or Burger King, or you take Zomato, the classic thing is that you have a fixed cost. Okay. And once you kind of take up the fixed cost, manage the fixed cost, and whatever incremental that is there in the terms of operating profit, it all starts flowing down to the bottom line. So you reach a point where whatever is your gross margins, they start going to your bottom line. So we get what is known as a operating leverage. So what happens? Revenue grows, EBITDA grows faster, EBIT races more, and the net profit grows even faster. So we are expecting that the company which is loss making at the EBITDA stage because of COVID, okay, will turn positive in FY22. We are through 21, right? And I want to tell you a couple of things is that, the Ind AS which is there, Ind AS 116, which is typically used these days, okay, we have done the entire modeling pre-Ind AS. Okay, so we build both models, and so all numbers that I am quoting you are pre-Ind AS. Let me repeat, all these numbers that I am talking to you about are pre-Ind AS, and I've given you the post-Ind AS effect in the brackets. So this will, the pre-Ind AS will actually tell you how profitable their business model is, what is the realistic thing that is there. Okay, we don't want to play around with the accounting entries. So when you say that you have a EBITDA margin which is double digit, actually it is in single digits. Okay, so the company is going to be EBITDA positive by FY22, which is the first good sign that you see. Okay, we expect EBITDA margins over the next 3 years, which is typically what we use to forecast in the broking industry, is expected to touch 2.7. Okay, as per post Ind AS, it's going to be 15.8. So 12.4 going to 15.8. Okay, EBIT and PAT are going to turn positive from FY25 to touch 24 crores and 30 crores respectively. Okay, again, post Ind AS, these numbers will look very good. 116 will be EBIT in 22 and 17 crores in at rupees 17 crores, and PAT in 25 at 30 crores. Okay, so and they will have substantial accumulated losses. Okay, so this is going to help them in getting very, very strong net profit growth, because they will not be paying any tax on their operating income till about 27. Whatever little bit of tax that they pay would come from all their non-operating income. Okay, the current negative working capital, which is close to 70 crores, will be 246 crores. So they are going to save and conserve a lot of cash. Okay, and they will be operating like a typical MNC kind of model that is prevailing in the market. And as a prudent measure, what Burger King will be doing is they will always maintain a cash kitty which is equivalent to their net negative working capital. Okay, so that's the part of being, saving for a rainy day. So you always have that kind of cash on the books. And in the future, if you're looking to be a businessman and you are in a similar situation, you must manage your cash very well. Okay, because unforeseen situations like what have occurred right now, if they were to happen, you can get badly rogered, if you don't have the cash pile with you to support you. So you must plan your cash flow very well. You must have cash reserves available to you, and this is a great thing that they're doing. Okay, So if you see, generating EBITDA is one thing, but when you're growing at a super fast clip, it is important that you generate a lot of cash flow. Okay. And if you see this ratio of the cash flow to EBITDA, you will find that, in FY22, because they're going from a CFO to EBITDA is going to be 78 times. Okay. So they're generating a lot of cash, and it will normalize in FY23 when they will be 3.3 times or 330% of EBITDA. Right? So very, very strong cash business. And when you're looking at a business which is representing negative profits, right? The net loss, but cash flow generation is very strong, and purely because of depreciation, all this thing is going to get hit. And why is the depreciation high? Because they are going out with very, very strong openings across the country. Okay, new stores, you need a lot of initial investment, which is going into fixed assets. So you'll have the kitchen set, and you'll have your other aspects which are there in an outlet. Okay. And then by FY25, they would be about 150% of their uh, operating profit, which is a very, very healthy sign that, a business is not guzzling cash, but it is creating a lot of cash. Right. So that is a very, very strong factor to look at. Okay. So if you take the valuation, okay, so how do you value this company? Okay, so there are 2-3 things that you can value this company on. We could have used the EV by EBITDA, but EV by EBITDA would not play a very important role because currently it's loss making and the true potential of the business does not come out. P though we can't use because it's negative. But to value it in the short run, what 2 measures that we can use is EV to sales is one, and we could take EV to CFO or market cap to CFO. So you're seeing the cash yield that is coming out. Why we have chosen to use EV to sales is the fact that uh, the business is growing at a very fast clip. Okay, so we've used EV to sales. We are in that early stage of growth, and if you see, Burger King today is at 1.5 times FY23 EV to sales. Okay, so I'm not taking today's EV. I'm taking today's EV, but I'm taking the sales value of FY23 when it's going to be more reasonable. Okay, and we use the fully diluted equity. So this is post-issue market cap at the price it is opening, right? Jubilant Foods is at about 5.7. Westlife is at about 3.5. Now both these guys deserve a premium purely for 2 factors. One is that Jubilant Foodworks revenue per store, okay, is the highest. Westlife, despite being there for a substantial period of time, its revenue per store is not that significant as compared to Burger King. So Burger King is really, really doing well on that aspect. Okay, but we have to also look at another fact that uh, Westlife has the McCafe going for them, which is a high margin business. Uh, Burger King so far does not have the cafe, and I personally think that that cafe will come into the business about 2 years down the line, and after 2 years of operations, that will kind of start throwing in money. Okay, so while we would not label the EV to sales multiple in line with Westlife development, but you can give it a 20% discount. So we are going to see some very rapid gains once the stock gets listed and the market realizes that you have a very, very strong franchise which is growing very fast and has got revenue per store which is better than Westlife. Okay, so uh, these are great numbers. Okay, and so given this, we recommend a subscribe for listing gains and long-term investing. Even if you were to the intrinsic valuation using DCF and all the parameters, it's coming out to between 87 to 93, depending upon which year do you take. So if you take 21, it is $80. If you take 22, it is 93. And if you kind of slightly change the assumptions in terms of cost of capital, it will come anywhere between 87 and 93 rupees. Okay. So this is what you will see happening in the market and play out. And if you go by the gray market premium, which is around $30, it is somewhere falling into that area. But having said that, what we will see happening is that the discounting of the market will start playing out at a very, very rapid rate, because Jubilant Foodworks is in a Burger King is in a very high growth path. Why do I say they are in a high growth path? Because Westlife, has a different way of scouting for locations and then growing from there. They have not ramped up ideally the way they should be doing. Okay. Somewhere around the line, Jubilant has kind of reached a saturation stage. So, on the S curve, they are kind of in a little more mature state than what they're still growth, but they're a little more mature. And Burger King is going to grow at a very rapid clip, because McDonald's has a very big presence in India, but Westlife is one of the two master franchisees, right? So the master franchisee of Westlife business is not that growing very fast. Okay, so to that extent, we are going to see some very high G. Okay, and when you do PE by G, you will find that Burger King is going at a very, very fast clip. So I will not be surprised if Westlife and Burger King get a similar valuation 6 months down the line. Okay, and if you do that, you're looking at 2.5% gains, 2.5 times of gains, right? So having said that, let me take a few questions. Yash is asking, can you share the financial model of Burger King that you have considered? I will explain to you what are the factors that I've done. I will be displaying that to you. Okay. Kapil Thukral is saying there are 19 stores based on franchise model. Actually, what happened now, when we did the call with the management, they said they have 8 stores. Okay. Or I could have heard them wrong. But typically, this is what is being told to us. Right. Ansh is saying, sir, RSP are huge documents. So which are the topics which we must read in the document? So you should, the RHP, although it might be a very big document, actually the things you should read is about the industry, about the business, and what are the key drivers for their growth. What are the rationale that they are talking about. Okay, those are the things to see. And actually, if you go through one red herring prospectus and you look at some of the documents, you will find that 90% of the report is jargon. Only about 10% of it is of value, and you have to, when you flip through the pages, you will come to know. So go through 1 or 2 RHPs and it will start making sense to you. Okay. So that's that. Let me go a bit down on the question line to see any questions are coming. So Mayurish is saying, sir, Burger King demand has increased after unlocks. So they have minimized their profit from 20 crores to minus 2 crores. So let me tell you another number that is there is that 55% of their presence, okay, was under lockdown. Now we will see all that. I will run you through the assumptions and what are the things that we have taken and into consideration and all that. Okay, but it was very important for me to give you the big picture. The big picture is very important. What happens with analysts? See, what is the difference between an analyst and an investor? An investor who's there in the business for a long term, okay, he wants to get the trajectory right, and he understands that returns are a factor of the market. You cannot control exactly how much you are going to get. Another thing we have to understand that business is also at the mercy of the market, not the stock market, but a lot of parameters in the economy, right? So companies do their best. They would aspire for 10x. They know that they will get 5x. Okay. And they will report 4.8x because they would keep something as a buffer, kind of delay it by a few days, push it into the next quarter, or all those kind of little bit of tweaking, which is permitted and is part of the process. Okay. There's nothing illegal about it, right? Analysts focus a lot on what is the margin. So, if you attend conference calls or of earnings calls of management, you'll find that they are talking about, uh, you know, 14.8%, and it came 14.7. So the next question is, why did the this thing come 14.7? So, we should not, it is my learning over the last 20 years, is that we should not be that stickler to, having hardcore numbers. Getting the trajectory right is very important. And as an analyst, I would always advise you and recommend you to be conservative. And you may be wrong in your growth projections, but you are on the lower side. The company did better than you. So although the company did better than you and beat your forecast, you would still be on the positive side, right? Everyone likes to see their stock go up. You said 50 and it went to 60. Great. Okay. So let's not be a stickler for getting the model as close and as right as the company's results. That is purely destiny for you. Okay. Or if you have some insider. Otherwise, it is impossible for even a management to know how much business Kolkata store is going to do in the month of January, sitting here today, right? You can estimate and you can never get the forecast right. So don't get over enthusiastic about getting the forecast right. If you got the forecast right, it was purely a stroke of luck. Okay, get the direction right, be right in terms of your logic for assumptions, and let the market do its thing. Okay, and you be conservative so that even if those numbers don't come about, if you're still bullish with lower prospects, okay, then you have a winning combination, right? So I will run you through the DCF valuation. Okay, there are a few things that we have taken. So the terminal value that we have taken is 5%. Intrinsic value works out to 87. We have used the CAPM model to calculate cost of equity, which would also be used as a weighted average cost due to the repayment of entire debt of the company. Okay, by the end of 21. And we have taken, because the stock is not listed, so we have taken proxy of Westlife Development because it's a very similar business to Burger King. Domino's is more like a pizza, right? Very high value product. Burger King is a very low value product and very similar to the operations of McDonald's, right? So these were some of the things that I shared with you. Okay. Now, when we are going through the entire business, these are the things that you should look at. So you should look at who are the promoters. We already spoke about the promoters. Now let's have a look at the leadership team. So Rajiv Varman, I told you, he's been 20 years F&B industry, Taco Bell, Burger King, right? Sumit Zaveri, who's the CFO, he's been with Nature's Basket, that is Godrej, Tata Starbucks, Tata Global Beverages, Indian Hotel. So he's a Tata man, good experience. So, he's got a good handle on raising finances. Prashant Desai comes from 63 Moons. He's a strategy and IR officer. Abhishek Gupta is the chief development officer. He's again a Tata guy, Tata Starbucks. So he understands the business of a cafe, and his services will be very, very strong going ahead, right? When they actually roll out the cafe. Then he's been part of Career Forum, North Delhi Power, etc. Namrata Tiwari is the HR officer. She's been with Kaya, Marico, Pfizer. Very, very, very strong credentials of the entire team. And Srinivas Adappa, who's the marketing officer, comes from Kellogg's. So they really know how to build a brand the American way. And it's a F&B kind of brand. So there are a lot of synergies in all the roles and the experience that they get. Okay. Another factor which is not there in the presentation is about the experience. But I guess after seeing their kind of credentials, they would obviously be minimum 10 to 15 years into the business, right? Then we have the board of directors. So the leadership team is what it does its job. So if I would equate this to cricket, okay, the leadership team are the players, the 11 players, and your board of directors is equal to the selectors and the trainer and the you know the health guy and all that, right? So if you see the board of directors, they serve more as a guiding principle, and they give direction to the strategy, and they get a lot of experience to them from various facets of life. And to take the story short, if you leave out the non-executive directors, Shiv Kumar Pulaya Dega, who's the chairman and the independent director, he was an erstwhile chairman and CEO of PepsiCo and MD of Nokia India, very strong credentials. And Rajiv Varman, obviously, we have spoken about him, right? So that was that. Just go through the others. The others is a previous CEO and whole-time director of Jubilant Foods, Ajay Kaul, getting a lot of experience about growing the business in India. Okay, look at Amit Manocha. He's the MD at Everstone Capital. So, he knows how to figure out capital raising, valuation, and all the things. And then we have Jaspal Singh Sabarwal, who's also from Everstone. So, they're nominees because Everstone has invested there. Then you have Peter Purdue, who joined Restaurant Brand International in 17 years. Sandeep Chaudhary at Avon Consulting, 5 years CEO. And finally, Tara Subramanian, right? 34 years in banking, real estate, blah, blah, blah. So this is how you would evaluate a management team. And when you have corporate people running the management team, okay, then you have got a very, very strong kind of a board and a performance team. And then, they get cracking. They can really, really do a lot. Okay. Before I move on, let me take a few questions quickly. How can the company grow inorganically in India? Does it have potential for an inorganic growth? Anmol, the market is so big and their product is so well defined. To have an inorganic growth, there has to be some kind of synergy. And the only synergy for inorganic growth that I can think of, if they were to go and take over another player who would have strategic outlets. Okay. And to my mind, at this point in time, when they're racing to put their plans in place, when they have their goals in place and they have such tall 700 store kind of their own store kind of thing, I don't think anyone would be a good fit for their business. So, they will have to do it organically and they will have to do it the way it is. Shubham Prajapati saying, based on current figure, we should not invest. However, considering future estimates, it's a good grab. Should we wait for listing or should we subscribe? So I think, as I told you, that the roadmap is very, very strong. Okay. It is a business. It's a consumable business. Okay. Which has taken a lot of fancy, and I'll come to it why, you should be looking at it also. Okay. So two factors I will tell you is that they've come in India as a value brand. They are a premium brand globally, but they realize that India is a very price sensitive market. So they've come in as a value brand. Okay, they price their products significantly lower than McDonald's also, in the entry level and all that. That is number one. Number two is the fact that their revenue per store is outbeating Westlife. So that means they're doing good business. They're only 5 years into it. Their stores are not mature. And, so there is a lot of scope for the business to keep growing. They still do not have the cafe. So when the cafe comes in, I think their growth is going to be more meteoric. So considering these three things, considering the growth rate that is there and considering the fact that they have negative working capital, they're going to be debt free. Okay. So there is not, and see, the IPO is very optimally timed. You're coming into the market at a premium. Okay. Bad for the investor, but great for the company. You have to give less shares. Okay. That is number one. Number two is the fact. Okay. Now, one more thing is that they have, they made a statement saying that they've come in at FY22 valuations, not the management. but the merchant banker said that, while valuing them, they've kept into consideration FY22 numbers. Okay. So this is what they said. So considering the fact that FY21 is a washout year, FY22 we've already started discounting and we are starting on a very positive wicket. Okay, I think we should get into the stock. That is my opinion. So I'm a subscriber at whatever price I get. Okay, I'm a subscriber even if at the fair value, because I think that the growth potential is immense. I'm looking at keeping this stock for another 10 years, and I believe that the unorganized to organized, the growth trajectory, uh, the ripple effect of operating leverage is what we will see. And if you have seen what happened to Domino's, I think the same story is going to play out here. Okay. So this is a stock, buy for keeps, buy it, convert your demat into physical shares so you don't sell them. Keep it in your Dadima's cupboard and see to it that they stay locked. Okay. So Anmol is saying, what are the different revenue segments of Burger King? By looking at their books, is revenue concentrated in any one of the segments? So they operate in only one segment, yeah. Their segment is in foods, and they're into fast food, and they're getting now into a little bit. So what do they offer? They offer you foods, they offer you burgers, they offer you fries, and there's a little bit of okay. There is a little bit of how should I say? There's a little bit of uh, soft drinks and beverages, but the big beverage, that is coffee, will come in much later, right? Do you think BK will expand apart from F&B? As I told you, they will get into cafe. They are not going to get out of the foods business. What they do globally, they will do out here. So they will Indianize more. They could become a you know three meal kind of concept, which what McDonald's has done. Okay, they could become a typical dine in dine out kind of. So they would be breakfast, lunch, and dinner. They would be snacks. They would be kiddies parties. They would address all and every kind of. So SD, I will not want to wager on a price target, but I think this stock can be a multi-bag. Let me put it that way. Ashish is asking, do you think demand for fast food will be there, especially with people becoming more health focused post COVID? So, foods are also getting more health conscious. You see, McDonald's menu habit has changed. And the kind of growth rate that we are seeing, I don't think things are going to change. Okay. Some other questions which we are taking. Bala is saying, in the foods industry, junk food market shares are growing in India. What about the penetration in tier 2, tier 3 cities? So they're using a cluster approach. They're going everywhere. Now the focus is east. Once Calcutta opens up, they will go everywhere. So today, when you talk of Gujarat and Maharashtra, they're everywhere. No? So you start with Mumbai, you go into Pune, you will go into Nasik, you will go into Aurangabad, you will go into then maybe Sangli, Kolhapur, Meerut, Satara, all those areas, right? So there's a progression which happens. So the penetration in tier 2 towns would happen in probably 3-4 years time. So the growth will constantly be there, right? Okay, let's move on to the next slide, right? So what is the strategy? I've spoken in bits and parts about this. Let me focus on being a globally a premium brand, in India value brand, value range from 100 and premium range above 150. I told you about capital raise being rightly timed, and most important is that the softness in the real estate market, coupled with the ability to lock in long-term rentals at depressed prices, will cushion the margins, isn't it? Saurabh Deep is saying, for a good listing gain, till when should I hold? 2 weeks or a month? I think probably in 2 weeks you will get your pricing. Ansh is, in general, how do you pick a company for a long-term investment? Not just speaking from hyper perspective, but in general too. So Ansh, that is what I told you. This entire concept is that you need to see who's the player, how growth hungry he is, what is the segment that they're operating in, what is the landscape, who is the competition, okay, what is the strategy of the company, what are the products that they're offering, do they have volume growth, value growth, growth through adjacent verticals, new product launches, market share gains in inorganic growth. You have to see a variety of factors. And what is the competitive advantage? Can I survive disruption in today's age? Today's age, the biggest thing is about disruption, right? So these are the factors that you need to keep in mind. And one of the most important factors that sums up all of this how should I say, intangibles is the ROIC or the ROC. ROIC or ROC. So the return on invested capital or the return on capital employed are a very, very good measure of all the intangible elements that we have spoken about. So if your ROIC is constant or it's improving, that really tells you what the company is doing. So if you want to capture these intangibles, look at their ROC and ROIC after having considered everything that I've told you. Okay. Then we go next to the ownership pattern. So pre-IPO, if you notice, Burger King was 94.3 and private placement of 5.5%. So now this 94.3 is going to come to 60 and institutions and public is at 40. So, this 90, and let me tell you, the public float is not going to be more than 10%. Okay. And about 5% of this will be picked up on day 1, day 2 of listing. And then, there is absolutely dry counter. And with the franchise of Burger King, this stock can go ballistic. Okay. So these are the issue details, 450 crores, fresh issue, offer for sale, 6 million, 60 million. Net proceeds of fresh K to repayment, as I told, outstanding balance, capital expenditure of setting up new restaurants, and other purposes. Okay. That's that so far. Now let's see how does the industry look. So, if you see, Domino's today has 1,355 outlets, growing at about 11%. Subway has grown at 6%. I think, if I think of scalability of a business, I think Subway would be the fastest growth, right? But they are averaging about a 6% CAGR, so over the last, so this is data is only till FY20. So you're seeing from 476, they've done 671. So they've put up 200 stores in the last 6 years. Burger King has done 200 stores. Okay, so you have a very, very strong growth there. McDonald's has averaged 5%, 489, which is good. But North India is good. South, the Westlife, which is the listed play, is not being that boisterous. And if you want to talk to me about what is the penetration saturation, so if you go into Hong Kong, which is probably 80 square kilometer or square mile area, or whatever is the geography, they have 80 stores there. Does Bombay have 80 McDonald's? I doubt. Okay. So the penetration level will continue. There is new store growth is a given, I think, for the next 10 years probably. Okay. Look at KFC. Okay. So they are at about 443. Now, Burger King will be at 440 in the next 4 years, of maybe 3 years. And that's a really, really tall ask. Okay. So you understand he is having a very high revenue per store. His store count is going to be respectable in the next 3 years, right? And then he will get that valuation, meaty valuation will come then. Okay. Anmol said, sir, what other multiples can we look at apart from EV to sales to find the value of a fast growing company? You can look at one of the measures that I would look at is to look at market cap to operating cash flow, or the cash yield, which we call. Okay. So that is a good measure of a business which is really doing well. Okay. So that is that. So having looked at number of outlets, Then you see the number of additional outlets. So, Burger King would kind of score everywhere, right? Region wise distribution. So, if you see, Burger King has got a very high presence in North India, 47%, and that's a good sign. That is the reason for the high growth number that they have per store. See, they have only one store in Calcutta, so the east is going to open up, and Calcutta is a very, very big geography for veg and non-veg food. Okay, and it's a very, very important destination. So I think there's a lot of good growth to come. Okay, uh, see the revenue CAGR. Okay, Domino's grew at 12%, Westlife 17%, Burger King has grown at 38.4%. So what happens is, when you look at a PE by itself, is not sufficient. You have to look at the PEG, and you should always make a cluster of the PEG versus the ROIC or the RSE. Have we discussed the competition landscape with McDonald's? So I have looked at McDonald's much earlier, so I derive my experience from that. Okay, Vishal is saying, how relevant is asset turnover ratio in this case? Very, very relevant. Very, very relevant, right? But rather than asset turns, you should look at revenue per store, same store sales growth. These are more of the measures that you should look. They actually tell you what is happening. Because in this business, the people's cost is quite high, right? So being a people's business, you are very high variable. See, you are a very high variable profit business. You'll have 64-65% as variable cost. The gross margins. Okay, so Rohit Singh is saying CAGR growth is due to low base. So I'm a 800 crore company. I'm not small. Okay, and yes, the CAGR growth is slow, but see, in 5 years, how many I've done, right? Let's go back. 5 years, I did 261 stores. Okay. 5 years, I did 261 stores, right? Domino's in 5 years has doubled its count. 400 they put up. 5 years they put up 400, which is very, very good. What has Subway done? Subway has done close to 200 in 6 years. McDonald's has put on 130 stores. KFC has put on 80 stores in 6 years. And Burger King has done 216 in 5 years. I think they are really killing it, man. Okay. Having seen that, we've looked at additional outlet, revenue growth, revenue per. Okay, so this is the revenue per store which I'm showing you. So see the 18, 19, 20 numbers. Okay. Jubilant is flat at 3. Westlife is shooting up at 4.85. Okay, Burger King is at 3.2, 3.4. So we are getting there, right? So presence of key international brands by outlets in India. So McDonald's 490, KFC 454, Subway 541. And see the number of cities. McDonald's is in 90, KFC is in 70, Subway is in 97, Domino's is in 282. Okay, Burger King is at 57. So, if you see like to like, I think, there's a lot of scope for growth to come in. We have to nearly double our city strength. Same store sales growth is, because we are a young chain, 12.2 and 29.2, last year's low, and this year, first 2 quarters, about 6%. So I think we are going just fine. See the product offering, if you see, Burger King is absolutely lower than the others, except for KFC, right? Look at the cost breakup. So I think cost base is stabilizing and gradually the margins will start picking up, as I told you. Okay, if you see the most important thing to see These charts, you can refer to these charts in the report that Ventura has done. I put those charts there. So that will give you more of an idea how things go. And this is that. I thought I'll now share with you the model. Okay, so I'm just going to Chrome tab. No, sorry, application window. And sorry, just give me a minute, guys. I need to open my spreadsheet. So there is certain problem. Okay, the spreadsheet is not opening. I will share the spreadsheet with you guys. Okay, you can all have a look at it, and then you can come back with me to discuss all this. But I will give you the spreadsheet after a few days, not immediately, right? So barring for yes, I will share this presentation with you guys at the end of this session, definitely. So any other questions that you would like to ask of me? We can take not pertaining to Burger King. We can talk about anything under the sun related to investments, and that will be that. So we are just heading to the hour. We are 56 minutes into the presentation. If you have any other questions, I'm willing to take. Okay. Any other questions? While doing valuation, which model should we refer more, FCFE or FCFI model? So I think we use FCFE. Okay, if there is more debt, you go towards the FCFF, right? How you select stocks when the market is at an all-time high? Sir, when can we take EV by EBITDA ratio analysis? So EV by EBITDA you should use when it is a very capital-intensive business, high net working capital, or there is a lot of debt involved. So typically, engineering businesses, you know, oil and gas. You would look at the infrastructure business. So that is where you will be looking at. Alex is asking, how do we learn fundamental analysis thoroughly? So all that I've spoken to you about is looking at fundamental analysis. You have to go more into depth with all this, right? That will lead you on. Okay. Sir, how can one improve at valuation? Priyanka is saying. So Priyanka, take a lot of sectoral data, look at all that and see how it plays out. Okay. So look at the relative valuations, look at the intrinsic valuations. It has to be a combination of both. Okay. Akshay is saying your market outlook after the stellar rally. So there are two things at play. Okay, one is the fact that so we have to look at it two ways. One is whether the COVID will come and hit us. Okay, so I don't think so. I think the COVID has been discounted. I'm not very very panicky about a lockdown happening. Okay, because I think we've taken it in our stride, and the government realizes that testing and taking precaution is more important. Nobody should die of COVID, but if you look at the statistical data, I think the death rate is not that alarming. Okay, it's a very dangerous disease, but the death rate, how many of those were actually old patients? So we need to look at that. I think more people die every day from other cases, right? So it is not the primary killer, but the fact that there is no vaccine around that product and it can spread, even when we are talking to each other, is creating the panic, right? So I think the green shoots are here to stay. Look at the GST collections, look at the electricity consumption, and also look at the fact that the measures that the government has taken to put money in the hands of the lower strata. Another very, very important thing that is happening, I'll give you an example. A very classic example I will give you is that in the real estate industry, value wise, okay, when I'm talking to you, value wise, bulk of these investments would happen in Mumbai and they would happen in Delhi. Now the fact that people are started moving out of cosmopolitan areas, rent rates are unaffordable. 50% of the industry doesn't want you to come back to work, they want you to work from home, right? All this is leading to people moving out of the cosmopolitan areas and settling at places where you can save money, as well as have a decent home for yourself, okay, from the rent that you save. So I think the real estate market, barring for Delhi and Mumbai, is going to grow big time. Okay, maybe not immediately, but over a period of time, and that is going to lead to significant new homes being created, which are at very low value, right? So the growth is going to come in the form of number of dwellings, and prosperity in other regions is also going to grow. Just take a look at Kumbh Mela. The amount of people who came there. Just look at the number of jobs that Yogi Adityanath has created in UP. So, rather than focusing on Delhi, Mumbai, and Bangalore, okay, which are totally stressed out, no growth can happen. And if you try to put growth here, these cities will collapse. The real growth is coming in hinterland India. Okay, agrarian growth, capital appreciation, localized businesses taking up. So, there is definitely that, the money is definitely getting circulated, not being concentrated in a few hands. And that is what is going to lead to, I think, resurgence of growth, which is going to be very, very broad based. And, if you continue to have good rainfalls, and the way the government has deployed gas, we have gone into ethanol blending, we are moving to 20%. Then we are putting water pipelines everywhere. Soon there will be a shift from cropping patterns, which are, not guzzling a lot of water, going to non-water guzzling crops, sectoral rotation, this, that, and the other. I think all these measures, which we do not really look at, will put a lot of relief on the natural resources, which is water and other such things. And to that extent, I think our economy will become more resilient to, the monsoon being there, not there types. Okay. So I think, given that, I think, we have optically a negative growth rate, 22 will be better and 23 will be even better. Okay. So given all these things, pharma doing well, IT has been stellar, infrastructure is really booming in the country. We are moving back to, Japanese guys, a lot of American guys are coming back. We are banning Chinese products. So, we have and along with the savings in energy costs, right? We've got something really going for us now. A lot of factors are coming together and conniving to put some real growth and value creation in India. And, now is the time to buy stocks that you think will do really well and put them in lock and key. I think in 10 years, you will make a lot of wealth. 20 to 2030 is the year for India, is the decade of India. Okay, so we are a 2 trillion economy. If we go to 5 trillion, maybe not by 25, even if we do it by 28, I think bulk of that growth will be captured by the organized sector. Organized sector needs capital to grow. They want to discover value. They are going to get listed. Okay, all the organized sector businesses are going against debt. They're all retiring debt. So everything, there is a lot of cost efficiency coming into businesses. So I think we are really set for some kind of rapid growth, and the snowball effect will be really something fantastic that we will experience, and you will be talking about it to your future generations. Okay. So Nihal Dhane is saying, is it okay to invest at these all-time high levels and when the markets are highly volatile? So I think, you are not in a stock market, you are in a market of stocks. Buy good businesses, don't look at the price, because See, I'll give you an example. Nestle is at 17,000 P इतना आ रहा है, intrinsic value पे चल रहा है. 18,500 रुपए intrinsic value is company is growing revenue at 10%. It will continue to grow. You know, people will eat more packaged food, and Nestle does only 10,000 crores out of business. यार, $2 billion भी नहीं होता है. Hindustan Lever, okay, ITC does 40,000 crores of business. That's $5.5 billion. Okay, in a 5 trillion economy which we want to be, India is one of the leading companies is doing only $5 billion of business. Are you understanding the kind of growth potential that is still there? If you look at retailing, 90% is unorganized. 90%. It's a 10 lakh crore market. Huge. And that is going to get organized over the next 10 years. So the potential for consumables, the potential for retail businesses, mass facing businesses is so immense. And we are forgetting one more aspect is that we are one of the cheapest cost centers globally. Okay, we've got one of the best talent pools. We have got all good natural resources at our end. And when people look at us as a $1.4 trillion mark for 1.4 billion people market, they are going to come here. They are going to, and when your infrastructure is getting speeded up, a lot of things are going to happen in India. So I think we are destined for something fantastic that will play out in the coming decade. Okay, all you need is 2 to 3 good years, without any kind of shit happening. Okay, so COVID was a bad shit that happened. Yes, there are some critical issues that need to be ironed out. We need to get our government finances into place. Okay, the GST revenue neutral rate is 23%. Okay, and our average rate is 16.5%. So there's a 7% deficit. So when you keep growing, that deficit in absolute term keeps growing wider, right? So somewhere compliance on the GST front has not happened adequately to the way that we would have liked. But the solutions to this is lesser government, more private participation, and things will take off. So Nihal Dane says, is it okay to invest at these all-time high levels and when the markets are highly volatile? So now let's take today's case. Okay, we are at 13,000, maybe probably heading to 14,000, and Burger King is coming at 1.7 times EV to sales when the other two players are available at more than double the valuation that it is available at, right? So I will buy Burger King today. I will not look at what is the valuation of the market because it is so cheaply valued. The growth is there. It is ideally going to take off. Shashi is asking, is it ideal to buy after listing or will the price be stagnant for a long term? I think price will appreciate and then remain stagnant. So that is my answer to you. Vishal, you're perfectly right. I think as long as you do it for the long term, it's not. Sir, I read somewhere that Burger King has some targets for 2026 to open outlet without even checking how the old ones are performing. So, well, Pankaj, I have gone through the old ones. They're performing fantastic. So, don't worry about it. Sir, while doing analysis of any companies, only annual report is enough to study. What other sources should we refer? So, annual report, chairman or promoter speech given to media bites and the con calls. I think that's good enough. And use your intellect. Okay, guys, it was a wonderful interaction with you. And if you do not have any more questions, I could take 2-3 more questions. We could end up for today. Okay, and I would just like to tell you guys that I run a couple of courses. I run one course on equity research and valuation, and there is another one that I run is I run a trading course. Okay, so if you guys are interested in any of these, you can hit me up and do spread the good word around. Thank you so much. Neha Agarwal is saying promoters are into certain litigations. So we have to take that into play. But those litigations, are they impacting the business? If they are not impacting the business, then it's okay, right? Good. Thank you very much, and we will have you again some other time.